In investing, emotions are the invisible forces that quietly shape every decision. Markets rise and fall, but it's not the movement of prices that destroys wealth. It's how investors react to them. Fear, greed, envy, and impatience have ruined more portfolios than any market crash ever could. The challenge is not to eliminate emotion, because that's impossible, but to manage it with reason and discipline. When prices soar and everyone around seems to be making quick fortunes, it's tempting to believe you're missing out. That's how bubbles are born, not from opportunity, but from the fear of being left behind. The wise investor learns to feel that emotion and still do nothing. When markets fall and panic spreads, the impulse to sell and cut losses grows strong. Yet, history shows that the greatest profits often belong to those who remain calm when others are terrified. The ability to stay still while the crowd runs in circles is a rare advantage. Controlling emotion also means resisting the urge to constantly measure yourself against others. Comparison fuels insecurity. Every investor has a different temperament, time horizon, and purpose. Chasing someone else's success leads to frustration and poor judgment. Rationality requires patience, and patience often feels uncomfortable. But it's in that discomfort that wisdom grows. The disciplined investor trains the mind to separate noise from reality. Decisions should come from facts, not feelings. By thinking in probabilities instead of predictions, you turn emotion into perspective. In time, the market rewards not the boldest, but the calmest. The one who keeps a steady hand when the crowd trembles, and whose judgment remains clear when others let emotion rule. Time is the quiet partner in every successful investment. It works silently in the background, compounding small gains into extraordinary results for those patient enough to let it. Most people underestimate its power because they are focused on the immediate, the next quarter, the next trade, the next headline. But wealth, like wisdom, grows slowly. The greatest advantage an investor can have is not brilliance or luck, but the willingness to wait. In a world where information moves at lightning speed, patience becomes a rare and valuable skill. The urge to act constantly, to buy, sell, or react, often leads to destruction. Every unnecessary decision invites error. True progress in investing often comes from long periods of doing nothing at all, allowing compounding to perform its quiet miracle. The investor who respects time learns that an activity, when guided by sound judgment, is not laziness but strength. Time also reveals truth. Over the years, weak businesses crumble while strong ones endure. Trends fade, but real value persists. Holding good investments through both sunshine and storms requires conviction, and conviction grows only when you understand that time, not timing, is what truly builds wealth. Markets can fluctuate wildly in the short run, but over decades they reflect reality with astonishing accuracy. By valuing time, an investor learns humility. It teaches that results cannot be rushed, that short-term setbacks are merely stepping stones in a longer journey. The compounding of capital mirrors the compounding of character, steady, patient, and quietly relentless. In the end, time rewards those who trust its rhythm, those who plant seeds early, water them wisely, and have the discipline to let them grow without constant interference. True investing begins with curiosity. Money follows understanding, not the other way around. If I were to start in 2026, I would treat investing as a lifelong classroom rather than a quick path to wealth. The market rewards those who study with patience, who read widely, and who think for themselves. Every great investment begins with deep knowledge of how businesses operate, how industries evolve, and how people behave when fear or greed takes hold. To study relentlessly means going beyond stock prices and charts. It means opening annual reports, understanding how a company earns its profits, examining its competition, and questioning whether its advantages can endure for decades. It's not enough to know what a company does. One must know as to why it succeeds and how it could fail. Reading about great businesses of the past, studying financial history, and learning from the mistakes of others can save years of painful experience. This kind of study isn't glamorous. It requires long hours, quiet focus, and a willingness to be bored before becoming wise. But over time, knowledge compounds just like money does. Each insight adds to the next, building a framework for rational decision making. When markets become irrational, it's the investor with real understanding who remains steady and confident. In an era where algorithms and artificial intelligence may dominate trading, the human ability to think clearly, reason independently, and recognize quality will remain irreplaceable. Numbers may tell part of the story, but judgment tells the rest. The investor who studies relentlessly doesn't chase predictions, they build conviction. And conviction is what allows them to act boldly when opportunity quietly knocks. The essence of sound investing lies in simplicity. The more complicated a plan becomes, the easier it is to make costly mistakes. Many people believe that sophistication in finance means complexity, but that's rarely true. Complexity often hides ignorance, while simplicity exposes understanding. If I were starting out, I would resist the temptation to chase every new financial invention or strategy that promises to outsmart the market. Most of them are built to impress, not to endure. Keeping things simple begins with clarity of purpose, knowing exactly what you're investing for and what kind of businesses deserve your money. A few well-chosen investments that you truly understand are far more powerful than a portfolio stuffed with assets you can't explain in plain language. If you can't describe in a few sentences how a company makes money and why it will continue to do so, you probably shouldn't own it. Simplicity also protects you from emotional overreaction. Complicated systems create confusion, and confusion breeds fear. A simple, well-understood investment plan helps you stay calm when markets swing wildly, because you know exactly what you own and why you own it. It's much easier to hold on to what you understand deeply than to cling to something you only half grasp. Moreover, simple strategies often outperform because they minimize unnecessary costs and decisions. Constant trading, diversification without understanding, and over-reliance on forecasts only drain time and confidence. True wisdom lies in doing a few things right and doing them consistently. By focusing on quality, patience, and understanding, simplicity becomes not a weakness, but a powerful shield against the chaos of the market. The investor who keeps things simple gives complexity no place to hide and lets clarity lead the way to long-term success. Ladies and gentlemen, if I started investing in 2026, I wouldn't chase what's new. I'd start by doing what has always worked using reason, discipline, and patience in a world that worships speed and speculation. First, I'd get rid of the noise. The financial world in 2026 will be louder than ever, filled with influencers, algorithms, and promises of overnight riches. I'd tune all that out. The more you listen to fools, the more likely you'll join them. Good investing starts by saying no. No to hype, no to trends, and no to anything I don't fully understand. Second, I'd study relentlessly. Real knowledge compounds faster than money. I'd read about businesses, not just stocks. I'd understand how they make money, how durable their advantages are, and how sensible their management is. I'd look for the rare cases where a great business is temporarily misunderstood or undervalued, and I'd act decisively when I find them. Third, I'd embrace the power of simplicity. In 2026, the financial world will be full of complex derivatives, cryptocurrencies, and AI-driven predictions. Most of them will sound smart and end badly. I'd rather own a few wonderful businesses I understand than 1,000 speculative plays I don't. Fourth, I'd keep my emotions in check. The biggest risk in investing is not the market. It's the investor. Envy, fear, and impatience destroy more wealth than bad luck ever did. If I can stay rational while others panic, opportunities will always come to me. Fifth, I'd value time above everything. Compounding is magic, but it needs decades, not days. I'd build an investing system that allows me to do nothing most of the time. because inactivity, when combined with intelligent ownership, is one of the greatest virtues in investing. And finally, I'd remember that character trumps IQ. You don't need brilliance to succeed in investing. You need integrity, consistency, and the ability to endure boredom. The world will always tempt you to do something foolish. Your job is to keep your head when everyone else is losing theirs. If I started investing in 2026, I'd do it the old-fashioned way, with patience, curiosity, and discipline. Because while technology changes, human nature doesn't. And understanding human nature has always been the best investment there is. In the world of investing, the greatest danger isn't always losing money. It's losing focus. The marketplace, especially in 2026, will be filled with distractions, social media, gurus, 24-hour financial news, and online chatter that promises easy wealth. Everyone will have an opinion, most of them loud, confident, and wrong. The problem with noise is that it clouds judgment. It tempts investors to act quickly rather than think carefully. The more attention you give to predictions, trends, and headlines, the less time you have to understand real value. If I were beginning my investment journey, I'd make silence my strategy. I'd ignore the endless noise about the next big thing, the new technology everyone claims will change the world, or the stock that can't miss. Most of what people call opportunities are simply distractions wearing a fancy suit. Good ideas don't need shouting. They reveal themselves quietly through strong fundamentals, sound management, and long-term durability. Noise also creates a dangerous illusion of knowledge. Hearing something repeatedly makes it feel true, even when it isn't. That's why serious investors must build a filter, a mental gate that allows in only facts and reasoned analysis while shutting out excitement and speculation. When others rush to act on headlines, I'd prefer to pause, think, and verify. In a crowd running toward chaos, the calm observer always finds better ground. In the end, successful investing isn't about being smarter than others. It's about being less distracted. The market rewards patience and clarity, not noise and motion. By staying calm in a world addicted to chatter, an investor protects not only their capital but their judgment, and that, in time, becomes their greatest edge.